In 1752, Benjamin Franklin helped found the first insurance company in America. It was called the Philadelphia Contributorship for the Insurance of Houses from Loss by Fire. Not exactly a name that rolls off the tongue, but the idea behind it was brilliant in its simplicity. A group of property owners in Philadelphia pooled their resources together to protect each other against fire damage. So if your home burned down, the group covered you. You contributed to the pool, and the pool had your back. This was 100% voluntary association. They didn't wait for the government to create a program. They didn't hand their money to a distant institution and hope for the best. No, they said, we're going to build the structure ourselves with the people we know and trust, and we're going to make sure that we are all protected financially. That's the oldest tradition in American finance. It's self-directed and community-driven, like so many of America's mutual aid associations were back in the days before the welfare state. Now, think about this. Benjamin Franklin's insurance company is still in operation today. How amazing is that? This thing was founded 24 years before the American Revolution, and the company is still trucking along today. And there's a very specific reason why. When Philadelphia Contributorship pools capital from its members or policyholders, it doesn't just sit on that capital. It sets aside just enough money to cover its expected near-term expenses, including any potential claims. Then it takes the rest and it allocates it to a range of real assets, each one with unique strengths and trade-offs. That principle is called asset allocation, and it's the key to becoming financially bulletproof. So what Benjamin Franklin and those Philadelphia property owners built in 1752, I see that as the template for what I think serious investors should be building today. Hello and welcome back to the Phoenician League podcast. I'm your host, Joe Withrow. Over the past 3 episodes, we've been building a case of sorts. In episode 7, I walked you through the LIBOR-to-SOFR transition and what it signaled about the structural shift that's been underway since 2022. Specifically, the end of the 4-decade era of falling interest rates and cheap money, and at the beginning of something very different. In episode 8, we talked about gold and the structural forces that are driving its remonetization. And in episode 9, I told you my Bitcoin story. 12 years in, I've seen pretty much every cycle. The thread running through all 3 of those episodes is the same. The financial architecture we live in is fundamentally changing. The climate we're in today is much different from what persisted from 1982 to 2022. It's a much different world now. I don't think many people realize it yet. If that analysis is correct, then the natural question is, okay, well, what now, right? How should we operate in this new climate? Let's start by assessing what I call Retirement Incorporated, or Retirement Inc. If you went to a mainstream, well-meaning, credentialed financial advisor tomorrow and asked them to help you build a financial plan, what would they likely tell you? They would probably tell you to max out your 401k. They would talk about pre-tax contributions and the benefits of diversification. Then they would recommend a balanced portfolio that consists of a range of stocks and bonds, probably through various exchange-traded funds or ETFs. That's what I've seen anyway. They are still operating as though nothing has changed. And so those advisors might also talk about paying off your mortgage before retirement, keeping 6 months of expenses in a savings account and then calculating your retirement number. That is, how much do you need to have invested with them before you can stop working? That's the financial planning playbook. It's the same one that's been in place for roughly 40 years now. Now, to be fair, that playbook worked out okay for some people during that time, especially those who got started earlier rather than later. But that playbook depended on an economic climate in which interest rates always went down. That assumption was baked right into the plan. As we've discussed before, from 1982 to 2022, interest rates fell from 20% to effectively 0. Guys, that's not normal. That's a once-in-history tailwind. When rates fall for 4 decades, stock valuations consistently expand as credit gets cheaper every single year. And bond prices rise as interest rates fall, driving those bond ETFs higher as well. So the entire financial system inflates upward on a tide of easy money and expanding credit. So to my way of thinking, That balanced portfolio wasn't a strategy as much as it was kind of a lucky passenger riding a 4-decade tailwind. As we noted in episode 7, the balanced portfolio had its worst year in modern history in 2022 when interest rates started to rise. That's telling, right? The worst year was not 2008 with the great financial crisis, and it was not 2001 with the dot-com bust. It was 2022 when interest rates went up. When rates went up, the bonds that were supposed to cushion the equity drawdown, they fell at the same time that equities fell because they are only a hedge in a world where rates always go down. Since 2022, interest rates have normalized. They are structurally higher today. The Federal Reserve has cut its target interest rate a few times since 2022. But guess what? The Fed cut, long-term rates went up, not down. Friends, the era of cheap money is over, and the conventional financial industry has not updated its playbook. So I want to give you an even more visceral example of why it's critical that we update our playbook. Say you had worked hard and put away $1 million in your retirement accounts in 2020. You were a millionaire, and your retirement hopes were in good shape. But then structural inflation accelerated, and everyone's cost of living increased dramatically over the next several years. In terms of purchasing power, do you know what that same $1 million from 2020 can buy today in 2026? The answer is $680,000 worth of goods and services. That $1 million can buy roughly $680,000 worth of what it purchased just 6 years ago. That means $320,000 worth of purchasing power just disappeared. It's gone. And that's not because the investments failed. It's because the dollars that those are denominated in, they've been quietly, steadily, and invisibly debased. That's the invisible tax we all have to grapple with. And it's why targeting an 8% return in your retirement account is not what financial advisors make it out to be, because that return will struggle to keep up with inflation over the long run. So my point is that the world Retirement Incorporated sold to us is very fragile. And I think it's time we recognize that and update our own playbook. Okay, now let me show you what I think the alternative looks like. I said at the top of the episode that Benjamin Franklin's model in 1752 is the template. It's self-directed, community-driven, and it's built on real assets and real relationships, right? Not on paper promises. I've spent the last decade building a financial framework around exactly that principle. We call it the blueprint, and it has 5 pillars. Before we walk through the pillars, please know that these aren't 5 separate strategies. They're one system. Each pillar reinforces the other. Capital flows between them in a cycle. And the result, if you build it deliberately, is a financial structure that holds up regardless of what happens in the paper financial system. That's what financially bulletproof means to me. It's not about getting rich overnight, right? In fact, it's not about getting rich at all. It's about building a financial structure for your family that will last for centuries. That said, the system doesn't rigidly require every single pillar to work. It can be customized. I want to be clear about that. And there are cases where one of the pillars may not work as well for certain situations. But each pillar does reinforce the others. They work together to create financial resiliency. That's the key point. All right, so let's walk through each pillar here. Pillar 1 is the cash warehouse. The reality of our world today is that we all need to hold some cash, and we need a secure place to keep it. So where should that be? A bank account paying near zero interest? A money market account paying 3.5% interest? A brokerage account with a cash sweep program? There's nothing inherently wrong with keeping a little cash in any of those places. But when you do, your money is working harder for someone else than it is for you. The cash warehouse flips the script with a concept called infinite banking, which is based on Nelson Nash's infinite banking concept, or IBC. Here's how it works in plain English. You fund a specially structured life insurance policy that's designed to build cash value at an accelerated rate. That cash value grows on a guaranteed basis, tax-free, and you can borrow against it at any time for any reason. Right? There are no penalties, no restrictions, and you don't have to ask anybody for permission. If you set it up correctly, that max funded life insurance policy will generate a steady rate of return on the cash that you put into it. Your cash value will grow over time. And here's the kicker. Let's say you want to use your cash value to invest in something. Maybe it's a rental property, maybe it's a mortgage note or a private investment, whatever it is. Well, you can access your cash right away through a policy loan, which is guaranteed, right? There's no approval process. That gives you the capital you need to make the investment outside of your policy. But because you only borrowed against your cash value, it's still growing inside the policy like nothing happened. So you still generate a rate of return on that cash that's inside the policy. And now, if you make the other investment, you're generating a rate of return on the same cash outside the policy, right? So you're essentially using the same dollars twice and getting return on each. So you can't do this with any other cash warehouse. If you pull money out of your 3.5% money market fund, you don't get the 3.5% interest on it anymore. So that's why I see infinite banking as the ideal cash warehouse. Now, you do create a policy loan when you do this. You owe money back to the insurance company. But guess what? There's no repayment schedule. None. You could never pay a penny back on that loan and nobody in the world would care one bit. And that's because your loan is fully collateralized by the policy's death benefit. So whenever the insured passes away, the insurance company would just subtract the loan amount from the death benefit and send the difference to the beneficiary. So what we're talking about here is creating a personalized financial infrastructure, right? A financial foundation that ensures the money you earn is always working for you, not for the institutions of this world. Okay. Pillar 2 of the blueprint is hard money reserves. That's gold and Bitcoin, which we've spent the last 2 weeks talking about. Gold and Bitcoin are the monetary base layer of the blueprint. They're the anchor. When you store a portion of your savings in something that cannot be printed, debased, or inflated away, you've built a foundation that will hold purchasing power over time, regardless of what happens in the paper financial system. So remember the $1 million in 2020? That's only worth $680,000 in real terms today, inflation adjusted? Well, guess what would have happened if you held that $1 million in gold or Bitcoin in 2020? If you had held that $1 million in gold, it would be worth nearly $2.8 million today. If you had held it in Bitcoin, it would be worth well over $10 million today. Now, I'm not saying to put everything in gold and Bitcoin. That's not the point. The point is that these assets can serve as the foundation underneath everything else. They don't generate cash flow, but they hold value. Gold has held its value for over 5,000 years. Bitcoin obviously doesn't have that kind of track record. But so far, its track record is good if you cut through the volatility. All right. So in a world where structural inflation is the mechanism by which governments quietly inflate away their debt burdens, having a small allocation to gold and Bitcoin can build your foundation. So guys, I don't see gold and Bitcoin as investments. I see them as savings. They're savings vehicles. And that's how I think we should treat them. Okay. Pillar 3 is cash flowing real assets. This is where the framework starts to generate income for you. And it's the pillar where I think most investors probably have the biggest blind spot. So the conventional model says to buy dividend stocks for income. And that's, fine as far as it goes. I own dividend paying stocks myself, but you have to understand what you're actually doing. You're dependent on corporate boards, on earning reports, on market sentiment for your income stream. If something fundamentally changes with the company, which is outside your control, your dividend might get cut. So I think there's a better way to generate income, and it's backed by physical things. Investment real estate is the classic example. Say you own a property, a tenant pays rent every month. If inflation goes up, your rents can go up too. If the stock market crashes, your tenant doesn't really care. They still need a place to live. So the income that you receive from rental properties is anchored to something real. Mortgage note investing is possibly even better for pure cash flow, and it's something most people have never heard of. And so instead of borrowing money from a bank to buy a property, you can become the bank and buy someone else's home mortgage, right? So then when the homeowner makes their monthly payment, it comes to you. You're collecting principal and interest every month, but it's backed by that real property with no tenants to manage. So you don't need to fix, leaky faucets. You can just collect the check. And then there are alternative income streams like music royalties, specialty commercial real estate, private lending, those kinds of things. The common thread across all of them is that the income comes from real things with specified contractual obligations, right? So pillar 4 is capital efficient businesses. Now, I talk a lot about how the age of paper wealth has ended, but don't get me wrong here. I'm not opposed to owning stocks. Having a well-constructed stock portfolio can be the cornerstone of a sound financial structure. Just think that you have to be intentional about it. The key word there is intentional. When you buy a stock, you become a part owner in the business. That's how we should think about it. And as long as you own good companies with a real business model that have a reasonable valuation and preferably a favorable macroeconomic trend that's behind them, you own something tangible. What I think is foolish is the entire passive investing paradigm. Faithfully socking money away into index funds or corporate target date funds where you have no idea what you actually own. And you're paying perpetual fees to these institutions for the privilege. To me, that's not really investing. That's financial surrender, really, in hopes that the number goes up. With the Phoenician League blueprint, every equity position maps to a specific investment thesis based on a structural macroeconomic trend. Then we layer on the positions as trends that will become complementary to one another over time. So the whole portfolio kind of can work together. All right, so pillar 5 is your protection architecture. And this is one that probably nobody likes to talk about, but I'd argue it's the most important pillar of all, because everything you build with the first 4 pillars is only as valuable as your ability to keep it. Protection architecture has 2 main components. It's tax optimization on one hand and digital privacy and security on the other. So let's look at tax strategy first. And I'm speaking from an American perspective here. But the simple fact is that the U.S. tax code is all about how to not pay taxes. I'm not kidding. The bulk of the tax code is about how to avoid the taxes that you would otherwise have to pay. The only way to do this is to create a strategic entity structure, which is to say an interlocking layer of LLCs with different purposes and different tax treatments. Now, everybody's situation is different, but if you set up a strategic entity structure and do proactive tax planning, it will save you serious money over time. And let's be clear here, this is not just for massively wealthy people, right? Regular households can benefit substantially from this too, including people who just work a job and have no business, right? I'm not exaggerating there. If you talk to my tax advisor, he would tell you that everybody should have a side hustle LLC, because then they could implement some really powerful tax strategies. Now, I know the vast majority of people never set up a tax strategy because they don't know that they should. And the accountant who does their taxes every April is trained just really to file what's in front of them correctly. Not to think proactively about the future or about the person's structure. But tax strategy is a game changer. Without it, I don't think one could ever be financially bulletproof. All right. Then there's digital privacy and security, which I see really as a risk management mechanism. We live in an era where data breaches are routine, where surveillance is the default, and where your personal information is being bought and sold without your knowledge or consent, pretty much all the time. Basic privacy measures, being deliberate about your digital footprint, that can reduce your surface area for hackers, for scammers, and people, for people who want to target you legally. If you're building real wealth, you need to think about this. All right, so let's step back and look at this, how the system works as a whole. The cash warehouse can fund the asset purchases. Those assets generate monthly cash flow, and that cash flow can come back into the cash warehouse. It will compound, and it will get deployed into the next asset. And this happens over and over again, right? It's with each cycle, the system gets stronger. Gold and Bitcoin sit underneath everything as the monetary base layer, so that no matter what happens in the paper financial system, the foundation's going to hold. And your equity portfolio captures upside from specific structural shifts in the macroeconomic climate. And then the protection architecture makes sure that you keep what you built, right? Everything works together. That's the general idea here. Of course, there are plenty of ways to customize it according to your own situation, but this model is largely available to anybody. You just need to have some income and or some assets to start building with. Okay, so let's bring it full circle here. And we're going to go back to 1752 and our friend Benjamin Franklin, right? What those Philadelphia property owners created with the insurance company they set up wasn't overly complicated. It was a structure, a deliberate, self-directed architecture for protecting what they had built. They didn't depend on institutions. They didn't wait for permission. They built it themselves with people they trusted around assets that they owned outright. As we have discussed, the financial architecture has changed over the last 4 years. The 4-decade tailwind of falling interest rates and cheap credit, that all ended in 2022. Meanwhile, the invisible inflation tax is quietly eroding the purchasing power of paper savings. So everything's changed, but the conventional financial industry has not updated its playbook, because doing so would require admitting that the advice they've been giving for 40 years is now obsolete. To me, the Phoenician League blueprint is the answer. It's the updated playbook. We've got 5 pillars, but it's one system. That's the key to true financial security and ultimately financial independence. Ben Franklin and those Philadelphia property owners, they had the right instinct in 1752. Self-directed, real assets, real relationships. And that means no dependence on institutions that seem to always prioritize themselves over the people they serve. Friends, that's the oldest tradition in American finance, and it's exactly what we need to return to. If you want to go deeper on how to actually build this framework, the implementation, the specific vehicles, and the practitioner network that makes it possible to execute without having to figure it all out on your own, that's exactly what we do inside the Phoenician League. So you can find more information at PhoenicianLeague.com, and I'll see you next week. That's going to do it for today's episode of the Phoenician League. If you found any value in today's conversation, please subscribe to stay plugged into the network. We put out new episodes every week. And if something we talked about today made you think differently about money or investing, please leave a review and let us know. That helps the show reach the people who could really benefit from it. And remember, financial freedom does not start with money. It starts with understanding and a fiercely independent mindset. So if you would like to dive deeper into the topics we cover, I invite you to get on the Phoenician League email distribution list at PhoenicianLeague.com. We often send out detailed written analysis on the various investment opportunities and the asset classes that we advocate, and we connect the dots across what's actually happening in the global economy. And then we host online strategy sessions periodically as well, where we can really drill into how to take full command of your financial future. So stay connected at PhoenicianLeague.com. And until next time, let's stay smart and let's stay independent. This is Joe Withrow, signing out.